How to qualify for a CGT exemption. There are honestly a lot of variables at play with CGT exemptions. Are you selling your home or investment property? How long have you owned it? Have you lived in it the whole time, or did you rent it out for a while? Did you use part of it for business? These are the factors that determine whether you qualify for a tax exemption or a concession, and if so, which one. So in this video, I'm going to share with you the exact same strategies I teach my clients and other accountants to help reduce or eliminate capital gains tax when selling a property. Specifically, we'll cover number 1, how the main residence exemption works. Number 2, how you can extend your main residence exemption even if you move out. Number 3, what happens when you use your home for business or rent it out. And finally, number 4, how your relationship status impacts how you can claim the exemptions and concessions. Are you ready? Let's start. When we talk about the main residence exemption, the first thing we need to know is what the tax office actually means by main residence. Basically, it's the place where you live, where your family lives, and where you keep all your personal stuff. It's usually the address you put down on the electoral roll. Now, a main residence can be a lot of different things. It could be a house, an apartment, or even a unit. As long as you're actually living in there and you intend to make it your home, it can count as your main residence. But you also have to actually live in the property for it to be considered a main residence exemption for tax purposes. So if you buy a block of land and you plan to build a house on it, that doesn't count as your main residence until you actually move in. And by the way, did you know that there is no specific rule on how long you must live in it for it to be your main residence for tax purposes? There's an ongoing misunderstanding that you have to live in it for 6 months, but technically, there is no rule about the length of time. So you can technically live in it for 1 month and move out, and it would still be considered your main residence. However, it does have to make sense, and you have to have evidence, because the ATO isn't going to believe you if you moved in for 2 days and decide to move out. Okay, so let's say you've got your main residence sorted, but then you decide to rent out a room to make a bit of extra cash, or maybe you start running a small business from your home. You might be wondering, is this going to mess with my main residence exemption? The answer is, it might. If you're using part of your home to make money, whether that's from rent or from your business, that portion of your house might be subject to capital gains tax moving forward. The tax office will look at a couple of things to figure this out. They'll look at how much of your house you're using for rental or business, like what's the floor area that's being used for this. And they'll also look at how long you've been using it for this purpose. If you're using the whole home or house to make money, one thing that can really be helpful is getting a valuation on your property when you first start using it for rental or business. This way, if you sell your house later on, you'll have a clear idea of what the property was worth when you started using it to make money. And you can use that figure to figure out if you made a capital gains or loss on that property. But the main thing to remember is that if you're using your home to make money, it's not automatically exempt from capital gains tax anymore. It's something you'll need to factor in when you're doing your taxes. So these are just the basics of the main residence exemption. There are a few more situations that could impact your ability to claim the exemption. For example, I get a lot of questions about how the exemption applies when you have more than one property. So let's talk about that. Because this is a situation a lot of people find themselves in, especially if they moved for work or bought another house. The key thing to remember here is that even if you own multiple properties, you can have only one main residence at a time for tax purposes. So if you live in one house and you got another one that you're renting out, the one you're living in is most likely going to be your main residence. If you were to sell both properties at the same time, your main residence property will qualify for the exemption and your rental property won't. A good thing here is that if you owned your rental property for more than 12 months, you get a 50% discount on your tax bill. So if the rental property is sold for a capital gain of $360,000, the ATO will only consider a net capital gain of $180,000 as assessable income for tax purposes. While we're on this point, let me quickly explain how much tax you pay on that as well. First, the capital gain is what you sold the property for minus what you paid for the property. Using a very basic example, let's say you bought the property for $620,000, including stamp duty, legal costs, and inspection fees, and you sold the property for $980,000. Your capital gain is $360,000. And like I said earlier, because you've held the property for more than a year, you only pay tax on $180,000 because there is a 50% discount. The next thing is the capital gains isn't a separate tax. It forms part of your income tax in your individual name. So if you earn a salary of $110,000, you'll add that $180K, bringing your total assessable income for the year to be $290,000. As a result, you will now fall into the highest tax bracket and you'll pay $96,638 in tax for the year. There is a common misconception that if you move into your investment property, then it would also be exempt from tax as it's now your main residence. But this isn't true. If you do decide to do this, there's still a capital gains tax on the property, but it will be apportioned for the period in which it was first an investment property. So say the property was an investment property for the first 4 years and then you moved in for 1 year and then sold it. The profit will be apportioned by 4 out of the 5 years and you'll pay capital gains tax on the 4 years it was your investment property. Now let's talk about another potential situation you might find yourself in, because a lot of people do. Let's say you buy a new house and you move into it, but your old house doesn't sell right away. Technically, based on the main residence exemption rules, your new home is your main residence. So then a lot of people stress that if they sell their original house after moving into the new home, they won't qualify for the exemption for the old house. This is not true, and the ATO has allowed some leeway with this when you're moving between homes. For up to 6 months, you can have 2 main residences, the old one and the new one. This can be really helpful because it means you don't have to worry about capital gains tax on your old house for up to 6 months. There's also another rule with the main residence exemption that you might find quite helpful. That's the 6-year absence rule, which I also call the 6-year rule. Basically, the rule allows you to turn your main residence into an investment property without losing the capital gains tax exemption. As long as the property was genuinely your main residence before you moved out and you don't nominate another property as your main residence during that 6-year period, you can claim the main residence exemption. So let's say you bought a house in 2013 and lived in it as your main residence for 5 years. In 2018, you got a job in another city, found a place to rent instead, so you decided to rent out your house and move. After speaking to your accountant, you decide not to nominate any other property as your main residence in case you decide to make your move permanent and eventually sell the house. So you rented it out for 5 years until 2023, then you decided to sell the house. Now, normally, if you've been renting out a property, you'll have to pay capital gains tax on any profit you made from the sale. But because you didn't nominate any other property to be your main residence, the 6-year absence rule kicks in and you can still claim the main residence exemption for that whole 10-year period, even though you're renting it out for 5 of those years. It's a really useful rule for people who need to move to work or other reasons but don't want to sell their home right away. And the good thing is that there's no limit to how many times you can use this rule as long as you meet the conditions each time. So you can move back in, move back out, and extend the rules. Just keep in mind that you need to have genuinely lived in that property as your main residence before you move out. And you can't nominate another property as your main residence during that 6-year period. One thing I should mention here is that foreign residents can no longer claim the 6-year rule. This rule kicked in May 2017. There was a transitional relief period until the 30th of June 2020 for properties bought before the 9th of May 2017. But this transitional period has now expired. So foreign residents can't claim the main residence exemption or partial exemption unless they meet the specific life event criteria and have been foreign residents for less than 6 years. These life events include things like partner or child having terminal medical conditions, or a death of a partner or a child, or breakdown of a marriage or relationship which led to the property being sold as part of a formal agreement. There are 2 more situations that you might find yourself in, and that would also impact your ability to claim the main residence exemption. These 2 are actual situations that most clients find themselves in, so you'll probably find it relevant to your circumstance. The first one is when Harry meets Sally. They both have properties that they consider their main residence, but they want to live in one and sell the other. What happens now? Okay, this may sound weird, but for tax purposes, Harry and Sally are considered in a de facto relationship for tax purposes. This means that they're entitled to only one main residence exemption between the 2 of them. The ATO classes a de facto relationship as a relationship between 2 people who, although not legally married, live together in a genuine and domestic basis. So now, Harry and Sally must choose the property they will consider the main residence. In this situation, Harry bought a house in 2018. He lived in it until he moved into Sally's house in 2024, which she had owned since 2019. Harry started renting this house at that time. Sally's house became their main residence for CGT purposes, and if Harry chooses to sell this house, he'll be subject to capital gains tax on his house for any growth in value from 2024. But he will not have to pay capital gains tax on any capital growth in the period before he started living with Sally, before 2024. If they decide to keep Harry's house as their main residence, they can use the 6-year main residence exemption rule to exempt this house from capital gains tax, even though they're living in Sally's property. However, this means Sally's house will have to pay capital gains tax on any capital growth in the period when it stops becoming their main residence in 2024, as they've elected Harry's property to be the one main residence. The good thing is that you don't have to decide which property to treat as your main residence until you sell one of them. This gives you some flexibility for tax planning and time to speak to an accountant. Now, I'm not saying not to get married or to move in with each other, but did you also notice that it's actually quite beneficial for tax purposes to not get married or be in a de facto relationship, as you would then have 2 main residence exemptions rather than 1. So you can tell your partner that's the reason why you decided not to propose. Now let's say things don't work out between Harry and Sally and their relationship breaks down. If they jointly own their property and they now need to transfer assets between them, there are some special rules that apply. In some cases, they might be eligible for a CGT rollover relief, which basically means they can defer any capital gains liability until the person who receives the asset decides to sell it. This is probably a bit more complex topic, so I might need another video for that, but that's the basic idea. The last thing I want to talk about is if the timeline was the opposite, where Harry first rented out the property and then met Sally, then turned his investment property into a home. If this is the case, he will need to apportion the capital gain between the period the property was his main residence and the period it was used for investment purposes. Basically, you calculate the capital gain as usual, then you apply the main residence exemption only to the portion of the gain that relates to the period you used the property as your home or main residence. So if Harry had bought the property for 500k and sold it for 800k, he would have a profit of 300,000. So if he rented it out for 5 years and then lived in the property as a main residence for 5 years and then sold it, he would apportion the gain like this. First, he calculates the total days he owned the property. In this case, it's 10 years, which means 3,650 days. Then he will work out how many days he used the property as his main residence. In this example, it's 5 years, which equates to 1,825 days. Okay, so here's the tricky part. To calculate the exempt portion of the gain, he must divide the main residence days by the total days he owned it for and multiply it by the total capital gain. So 1,825 days divided by 3,650 days is 0.5, and then 0.5 times 300k equates to 150,000. This is the exempt portion of the gain. The remaining 150k is a taxable portion of the gain. And don't forget, he's still able to claim the 12-month 50% discount, so he can reduce the net capital gain to 75,000, which Harry must then include in his tax return and pay tax on his income. Okay, so it's pretty confusing, but it is very important to keep good records of when you used the property as your main residence and when you used it for investment purposes, as this will make your accountant's job much more easier. That should cover all the CGT exemption basics. Now, before you go, there's a property investment strategy that's been gaining a lot of attention lately. Have you heard about using a self-managed super fund or a SMSF to buy property? If you have, you might know that there are a lot of tax implications that can be quite different from what we discussed in this video. So I recommend checking out this video, which gives you the right comprehensive breakdown of how you can run the show with a self-managed super fund. That's all folks, I'll see you guys later.